In this episode, we're going to look at 4 companies that I would not invest in today, even though they are large dividend paying companies. I'm going to take you behind the scenes and look at my evaluation process and what I go through before I decide on which companies to invest in. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, I'm going to cover 6 topics with you. Topic number 1, we'll take a look at our approach to investing. Then I will show you my criteria for investing. And then we're going to look at 4 real life examples at 4 actual companies and see how they perform when we look at the payout ratio, the PE ratio, the debt, and then also determine whether or not a company is undervalued or overvalued. In this episode, we're going to look at the following 4 companies: International Flavors and Fragrances, Home Depot, SAP, and Mercury Insurance. So let's get started with topic number 1, our approach to investing. And our approach is really simple. It's to invest for the long term and help you build a resilient portfolio that's going to generate growing income for you each year. And the key words here are long-term, resilient, and growing income. We want to invest for the long term, not just for a few days, a few weeks, few months, or even just a few years. We are investing for the next 10, 15, 20, 30, 40 years. So our perspective as dividend investors is always a long-term perspective. And then we want to build a portfolio that's going to be resilient, regardless of what happens in the stock market. Stock markets go up and down all the time. We have market downturns, we have market crashes, but we want to make sure that your portfolio is resilient and it continues to generate not only income each year, but growing income for you every single year. So how do we do all of this? Well, to help us, we have established a criteria for investing. And that is our next topic in this episode. So what is our specific criteria for investing in dividend stocks? So for that, I've created what I call the 12 rules of simply investing. The rules are designed to lower your risk, save you time, and help you earn more. A company must pass all of the rules before you invest in it. So I'm going to say that again. If a company fails even one rule out of the 12, skip it. Move on to something else. So let's take a look at the 12 rules, and then we're going to jump right in to our specific real life examples with 4 companies. So rule number 1, do you understand how the company is making money? If you don't, skip it, move on to something else. You don't need to be an expert at exactly what the company is doing, but you should have a general idea, general knowledge of how a company is making money. How does Walmart make money? They are buying products at wholesale and then selling them at higher retail prices, and that's how they make money. Rule number 2, 20 years from now, will people still need its products and services? If not, if you don't think the company will produce product and services that'll still be in demand 20 years from now, then the company is going to fail rule number 2, and you skip it and move on to something else. Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is the company recession-proof? Rule number 5, is the company profitable? Rule number 6, does it grow its dividend? Rule number 7, can the company afford to pay a dividend? Rule number 8, is the debt less than 70%? Rule number 9, we avoid any company that has had a recent dividend cut. Rule number 10, does the company buy back its own shares? Rule number 11, is the stock priced low? And so there's 3 parts to rule number 11, A, B, and C. And in part A, we're going to look at the PE ratio. We're going to make sure that it's low, and I'll show you that in today's example. Then we're going to look at the current dividend yield, and we're going to see that in today's episode as well. And then the last part is to look at the PB, price to book ratio. And then rule number 12, keep your emotions out of investing. So there you have it. Those are the 12 rules of simply investing. Now, we're not going to have time to go through each of the 12 rules today because we are looking at 4 different companies. But what we are going to focus on is these 3. Now, you can see them up on the screen. I've highlighted them there. Rule number 7, can the company afford to pay a dividend? Rule number 8 is the debt less than 70%. And rule number 11, we're going to look at 11A and 11B. So we're going to cover total of 4 different criteria against 4 actual companies. So just a quick note at this point in the episode. Remember, the data that we're going to look at on the slides and the data we're going to talk about is only relevant as of this recording. So the 4 companies, and I told you in the beginning, the title of this episode is the 4 stocks that I would not buy today. So that doesn't necessarily mean that these 4 companies are going to be bad investments forever. We don't know that. I don't know that. So based on the data as of this recording, I'm going to show you my evaluation process and why I would not invest in those companies today. However, in the future, the data is going to change. The company's debt level could change, the dividend that they pay could change, the payout ratio could change, any number of things could change. And so that's the beauty of our system, is we apply the 12 rules of simply investing when you're ready to invest. And then at that time, we evaluate a company against the 12 rules. So the 4 companies I'm going to show you today, in the future, they may or may not be good investments, and they will have to be evaluated in the future against the 12 rules. So let's continue. We're now going to jump into the 4 examples with the 4 companies in the episode. So we're going to start off with the payout ratio. Okay. So quick reminder, especially for those of you that are listening for the first time to this podcast, very quickly, what is a dividend? A dividend is essentially the company sharing its profits with you, the shareholder. So if a company is paying a dividend of $1 per share, and that's the annual dividend, and you own 1,000 shares, you're going to receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend of $1 a share. Now, the dividends are deposited directly as cash into your trading account, and you can spend those dividends if you wish, or you can reinvest them. And as dividend investors, we like to reinvest them into other stocks that also pay dividends. And that's how you can grow your dividend income each year. So essentially, the dividend is the return on your investment while you hold on to your shares. Because the stock price can go up and down, but as long as you've purchased the shares and you hold on to them, the dividends are paid not based on the share price, but they're paid based on the number of shares you own. So let's get back to what we were talking about, the payout ratio. And that's essentially what is rule number 7. So when we say, can the company afford to pay the dividend? What we really mean is, let's take a look at the payout ratio. If it's too high, the company may not be able to pay the dividend. If it's low, that's a good thing, especially for us as dividend investors. So let's take a look at the payout ratio. It's quite simple. You can see it up on the screen right now. The formula is the dividend, the annual dividend, divided by the company's earnings per share. And so we've already talked about dividends. You know what a dividend is. What is earnings per share? That's essentially the company's profits. How much money it makes at the end of the year. You've all the revenue that they've gotten, and you subtract the cost of manufacturing the goods, all the expenses, and you're left with earnings per share. Now, a quick reminder here, I do have an entire episode dedicated to the payout ratio. Lots of real life examples in that episode, lots more detail around the formula. So if anybody is interested, I highly recommend you go back and watch episode number 2. But we're going to keep moving forward. So in this example, for the payout ratio, we are going to take a look at a company called International Flavors and Fragrances. IFF. The company was founded in 1909. It's headquartered in New York, has a little over 22,000 employees, and has a market cap of $20 billion as of this recording. So this is a large company. It is a large dividend payer. Now let's take a look at the company's payout ratio. Now you can go to Google Finance, you can go to Yahoo Finance, any of these websites that give you stock prices, they will have the two numbers that we need for this formula. They will tell you what the company's annual dividend is, and they will tell you what the company's earnings per share are. So in our example with the company we're looking at, IFF, the dividend as of this recording is $1.60. The earnings per share is 96 cents a share. So if we divide $1.60 divided by 96 cents, and of course we want to express that as a percentage, it's just a lot easier that way, you can see that the payout ratio for this company is 167%. Now, what does this mean? Take a look at what you see on the screen in front of you. The company earned 96 cents a share. That's how much money they made. But then they turned around and paid the shareholders $1.60 for every share that the shareholders are holding on to. So where did the company come up with the money to pay the dividend? Because the dividend is much higher than the earnings per share. In fact, it is 167% higher, right? So that's a problem. The company is either borrowing money from somewhere else to pay the shareholders, or it's expecting that its earnings are going to go up by the end of the year. We're recording this in April, so they still have lots of months to go before the end of the year. So maybe they're hoping that the earnings are going to go up and they're going to be able to pay the dividend, because the dividend isn't paid all in one shot. It's paid quarterly. It's $1.60 for the year. It's an annual dividend. So that could happen. But the other thing that could happen is the company could reduce their dividend or eliminate it altogether. And as a dividend investor, that is concerning. That's a red flag. So this is not a good place to be. When we take a look at the payout ratio, you can see it up on the screen, 167%. It is very high. Now, on the other hand, if this example, the company made 96 cents a share and they paid a dividend of 25 cents a share, that's perfectly fine. The payout ratio is less than 100%. They've got more than enough money to pay the shareholders, and then the rest of the money, they're reinvesting it back into the business to grow the business. But in this case, the company isn't able to do that because the payout ratio is 167%. So that's one indicator to look at. There are other things, of course, and we're going to continue with the rest of the episode that we're going to look at. So the question on your mind probably is, okay, then what is a good payout ratio? So when you're looking at a company, you can take a look at the payout ratio. What is a good number? So for us, again, that's rule number 7. Can the company afford to pay the dividend? We like to see the payout ratio at 75% or less, because that gives us a little bit of a margin of safety. In case the earnings drop a little bit, it's not going to impact the dividend. It also has enough room in there for the company to increase its dividend. Because companies like, if we look at Coca-Cola, over 56, 57 years of consecutive dividend increases, right? If we look at Procter & Gamble or Johnson & Johnson, over 60 years of consecutive dividend increases. Every time the company increases its dividend, that's more money in your pocket. So by looking at a company that has a low payout ratio, there's enough room there for the company to grow its dividend. And so that's what we look for in rule number 7. Now let's take a look at the PE ratio. So what exactly is it? Well, it stands for price to earnings ratio. And again, if anybody's interested, I have an entire episode dedicated to just looking at the PE ratio. And you can go back and watch episode number 32, and we cover that in a lot more detail. So for now, it's really simple. It's a very simple formula, and you can see it up on the screen. It's the company's share price divided by its earnings per share. And I've already explained what the earnings per share is. We talked about it before. The share price is the company's stock price, whatever the shares are trading at. So in this example, we're going to look at a very large company, SAP. They were founded in 1972 in Waldorf, Germany. They have a little over 109,000 employees, and the company is currently valued at over $313 billion. So let's get back to our formula. Again, you can go to Yahoo Finance, you can go to Google Finance, any of these websites that give you stock prices, and you can get the two numbers that we need. As of this recording, the company has a share price of $263 a share, and the earnings per share is $2.87. So what we're going to do is we're going to divide the share price by the earnings, so $263 divided by $2.87. And you can see that the company has a P ratio of 92. So is that good or bad? We're going to take a look at it in just a few seconds here. We're going to compare it to another competitor. But let me just take a minute to explain what we're looking at here. So when the PE ratio in this case is 92, and you can see it up on the screen, we've got the share price number and the earnings number as well. What it means is that for every single share that you're buying in this company, you are paying 92 times what the company made. So in this case, the company made $2.87. Multiply that by 92, you end up with the share price of $263. So you're paying 92 times what the company made for a single share in this company. So again, is that good or bad? Let's take a look. We're going to compare it to its direct competitor, which is a US-based company, Oracle. And if we take a look as of this recording today, the share price for Oracle is $132. Their earnings per share is $4.26. And so their PE ratio is 31. So all things considered equal, right? We're not going to look at the debt. We're not looking at anything else for both of these companies. All things considered equal, Oracle is a much better deal because you're only paying 31 times what the company earned versus paying 92 times what the company earned, right? So it's important. We want to buy the stock when it's at a low price, and we're going to talk about that in a minute in this episode as well, because we're going to look at value. But for now, if we compare the two numbers, the PE ratio, up on the screen, Oracle seems like a better deal. Now, what is a good PE ratio? And the answer for that is, of course, our rule number 11A, when we're looking at is the stock price low. And so for us, we're looking at a PE ratio of 25 or less. So in this example, SAP and Oracle would not satisfy the criteria or rule number 11A. But you can see what I'm trying to show you in the example is look at how high the PE ratio was for SAP. It's 92. You'd be surprised. There are companies out there today where the PE is over 100, 200, right? Very high PE numbers. And so we're not interested in those kinds of stocks because they're overpriced and you're paying too much money to buy a single share in that company. So our PE ratio, we like to see it at 25 or less. Let's move on to debt. We're going to cover that first, then we'll go back to value, which is our last topic in this episode. So let's cover off the debt. Company debt, also known as corporate debt, refers to the total amount of money a company owes to its creditors, including loans, bonds, and other financial obligations. To put it simply, company debt refers to the total amount of money that a company owes. And if anybody's interested, I have an entire episode dedicated just to that. And you can go back and watch episode number 96, and we cover that in more detail. In this part of the episode, when I say debt, what I'm referring to is the long-term debt to equity ratio. So long-term debt, this is money that a company owes its creditors, but it isn't due in 12 months or less. Because if it was, that'd be short-term debt. So we're just going to look at long-term debt. Remember I said at the beginning, we're long-term investors. So this fits in perfectly. The formula is super simple. It is the long-term debt divided by the shareholders' equity. In this example, we're going to take a look at the debt level for Home Depot. The company was founded in 1978, headquartered in Atlanta, Georgia, has a little over 470,000 employees, and a market cap of $360 billion. So like I said before, the numbers that you see on the screen here, you're going to be able to find them on Yahoo Finance, Google Finance, any website that's going to give you stock prices. And for these two numbers, you need to go to the financial statements of the company itself and take a look at the balance sheet. So I've done that already, and we can take a look. The long-term debt for Home Depot, as you can see on the screen, is $57.596 billion, and the shareholders' equity is $5.78 billion. So we're going to take our formula, which is the long-term debt, divide it by shareholder equity, and we're also going to multiply it by 100 because we want to express that as a percentage. So as you can see on the screen, we're going to take 57.59 billion divided by 5.78 billion, and we can see that the debt level for Home Depot is a little over 995%. Now, if that seems high to you, it is. There are companies out there that have a debt level of 0. Some of them have a debt level of 5%, 10%, 20%. Even 100, 200, 300%, the range varies. But just intuitively, you can take a look at this and you can see that the number seems a little high. So what's the problem with a company carrying too much debt? So the issue is going to be if there's a recession, if there's a market downturn, if there's inflation and interest rates rise, then companies that are carrying a large amount of debt are going to have a very hard time being able to service that debt and pay it off, or even pay the interest on that as well. So that's going to be challenging for companies. And also, if a company is already carrying a large amount of debt, it may impact its credit rating. So it's going to have a harder time trying to raise money if it ever needs to do so. So all things considered equal, the lower the debt level, the better the company is going to be. It's going to be in a much stronger financial position. What is a good debt value, the long-term debt to equity ratio? For that, we go to rule number 8, and it's right in the rule. It says, is the debt less than 70%? So we're looking at a number of 70% or less. Now, there are going to be some exceptions here, because I know people are going to put those in the comments. There are exceptions for companies like utilities, okay? Companies that are perhaps even REITs, real estate investment trusts, right? Any company that's very capital intensive, where they need to borrow a lot of money, where it takes a lot of money to build and grow the business and keep the business running, will, of course, carry a lot more debt. So we cover that in more detail in the episode I mentioned, episode 96, but even in more detail in the Simply Investing course. But for now, in general, the majority of the time when you're looking at a company, we want to look for companies that have debt of 70% or less, because that is a margin of safety that we're looking for in case the market does crash, in case interest rates do go up, in case inflation goes up. If you've invested in a company that has very little to low debt or no debt at all, then that company is going to have a much better time surviving any market crashes in the future. Now, let's move on to our last topic, and this is value. Is the stock priced low or is it priced high? So if it's priced low, we call it it's undervalued. If it's priced high, it's going to be overvalued. Now, I have an entire episode dedicated to that, and I show you how to figure out if a stock is low or high. We go into a lot of details with real life examples. I encourage you to go back and watch episode number 1, and we cover all that in there. Now, you may have heard the phrase, buy low, sell high. Why do people say that? And why is it important to buy low? You can see it up on the screen here. Stock prices go up and down all the time. This is an actual graph for an actual company, and you can see, like I said, prices go up and down all the time. You can see at the very peak, that's going to be the high. That's going to be the company is priced high. It's overvalued. When it's low, that's the undervalue area where the stock price is low. Let's say this, at the low price, it was $20 a share. At the high price, it was $100 a share, right? There's no point in buying more shares at $100 or at $120 or at $95 because you are already close to its all-time high of $100 a share. The likelihood of the shares going even higher in the future is very low. And we don't want to do that, right? If you buy it low when it's $20 a share, if you're buying it there, the likelihood of the stock price going up is pretty high. And so then you will be able to buy low and sell high. So in addition to the dividends, there's capital gains here. You can buy the shares for $20 and sell them for 80 or even 100, right? Just as an example. And that's going to increase your capital gains and profits. So there's two advantages to buying low. I've already talked about the first one, maximize your gains, and you can maximize your dividends. And I'm going to show you in this example what I mean by that. So you can see it up on the screen. We have scenario A. So let's say today you were looking at a company, looking at investing in it. The company seemed interesting. Everything else was fine. The payout ratio was fine. The debt was fine. Everything else was fine. The stock price is $100 a share. The company is paying a dividend of $1.50. Okay, so the dividend yield is 1.5%. So if you were to buy this company today at $100 a piece, if you invested $1,000 or $5,000 or even $500, the return on your investment while you hold on to the shares would be 1.5%. And that's not very high. Scenario B, let's say the same company, a couple of weeks from now, a couple of months from now, the stock price drops. Let's say it drops to $25 a share. The dividend remains the same. It's still $1.50. Now look at your dividend yield. It's going to be 6%. So that is a much better return on your investment while you hold on to the shares. Why is the dividend yield higher? The reason is because the stock price is $25 a share, you are going to be able to buy a lot more shares than you would have been if the share price was $100 a share, right? Think about it. If you had $1,000 to invest in scenario A or $1,000 to invest in scenario B, you're going to be able to buy more shares because the stock price is much cheaper. It's $25. And remember, the dividends are paid not based on the stock price, but based on the number of shares you own. So if the stock price is low, you're going to be able to buy more shares. And guess what? The more shares you have, the more money you're going to make in dividends. And that's why in scenario A, you would only make 1.5% return on your investment. In scenario B, you would make 6% return on your investment. All things considered equal, I would rather make 6% return on my money rather than 1.5%. Okay, so that's the advantage of buying low. And of course, if you wanted to in the future, you could sell it when the price was high and you could maximize your gains. But in between, if that took 2, 3, 4, 5 years for the price to go from low to high, well, you're collecting dividends. And you're collecting a lot more in dividends because you bought them when the stock was priced low. So here's the formula. Again, in episode 1, we go into more detail about where the formula comes from. Here, I'm just going to give it to you. It's up on the screen. If a company's current dividend yield is greater than its average 20-year dividend yield, then the stock is considered to be priced low, undervalued. Okay, and of course the opposite is true. If the current dividend yield is equal to or less than the average 20-year dividend yield, then the stock is considered to be priced high. So again, quick reminder, episode 1, we go into more detail there. So now we're going to take a look at our last company in this example, Mercury Insurance. This company was founded in 1961, headquartered in Los Angeles, California, has over 4,000 employees and a market cap of over $3 billion. So let's take a look at this company as of this recording, as of today. Is the stock undervalued, price low, or overvalued, priced high? So again, we're going to go to Yahoo Finance or Google Finance. You can get the current dividend yield. The average 20-year dividend yield is a little more challenging to calculate. I'll show you where I get the numbers from. I get them from the Simply Investing web application. We'll talk about it very briefly towards the end of the episode, but nevertheless, that's where we get the numbers from. We calculate them. And so let's take a look. For Mercury Insurance, the current dividend yield as of this recording is 2.4%. And the average 20-year dividend yield for this company is 4.7%. So since the current dividend yield is less than the average 20-year dividend yield, this company is overvalued. Okay, so it's priced high. And we never want to overpay for an investment. And so rule number 11B, right? That's part 2 of rule number 11, is the stock must be undervalued, which means its current dividend yield should be greater than its 20-year average dividend yield. Otherwise, company fails rule number 11B and you move on to something else. Here's a quick tip, right? We looked at the 12 rules. There's a lot of things to evaluate. I'm going to show you how we do it very quickly, but there is a lot of things to evaluate. If you were doing this on your own, I would go straight to rule number 11B. If a company fails rule number 11B, there's no point in evaluating the rest of the rules. There's no point in looking at exceptions to the rules. You just skip it and move on. I've been investing for more than 25 years as a dividend investor. I have never violated rule number 11B. This is extremely important. We never want to overpay for an investment. It's better to be patient. It could be a stock that you're really interested in and you really want to buy it and you fall in love with the company. But I urge you to take a look at rule number 11B. If it fails rule number 11B, then you need to be patient. Stock prices go up and down all the time. You need to be patient. Eventually, the stock will come down to its undervalued price. So, does this mean that you should go out today and buy any stock with a low payout ratio, a low PE ratio, a low long-term debt to equity ratio, and if the stock is undervalued? The short answer is no. There's a couple of more things we need to look at, and I covered those in the beginning, the 12 rules of Simply Investing. What we did in today's episode was focus on rule number 7, rule number 8, rule number 11A and B. And so that's what we looked at. You can see that there are quite a few other rules on the screen. You can see all 12 of them. I'm not going to go through them now because we've already covered them at the beginning of this episode. And remember, a company has to pass all of the rules in order for you to invest in it. If it fails one rule, skip it, move on to something else. So I have built an all-in-one solution. We've spent a lot of time putting together the Simply Investing web application and the Simply Investing dividend course that's available to you. The Simply Investing web application tracks over 6,000 companies in the US and in Canada and applies the Simply Investing criteria to all of those companies every single day. So you can see up on the screenshot here, you can get the current dividend yield, you can see rule number 5A, rule number 5B, rule number 6, and the software will highlight any of the failures in the Simply Investing rules. And that way, you know exactly immediately which companies to avoid and which ones to consider for investing. The application, the web application, also comes with the Simply Investing course. It is a complete dividend investing course. Module 1, we cover the investing basics. It's an online self-paced video course. Module 2, we cover the 12 rules of Simply Investing. Module 3, you learn how to apply the 12 rules. Module 4, We show you how to use the Simply Investing web application. It's going to save you lots of time. Module 5, how to place your first stock order step by step. Module 6, building and tracking your portfolio. Module 7, when to sell, which is just as important as to know when to buy. Module 8, especially if you have mutual funds, ETFs, and index funds, how to reduce your fees and risk. Module 9, I give you your action plan to get started with investing right away. And in Module 10, I answer your most frequently asked questions. So our all-in-one solution, like I said before, you get the course, you get access to the web application. If you're interested, you may want to write down the coupon code SAVE10, SAVE10. It's going to save you 10% off of our all-in-one solution. If you enjoyed today's video, be sure to hit the subscribe button, hit the like button as well, and for more information, check out our website at simplyinvesting.com. Thanks for watching.